Hey, how's it going, everyone? Zachary Jensen, Managing Partner of TaxWise Financial Services here, where we're empowering small business owners with tax savings so they can grow and build their wealth faster. Today, we're going to go over the grouping election for real estate professionals. We're going to go over what exactly is it, how to use it, what are the scenarios that make sense to use it, and what are the ones that don't, and then a few examples. So let's just dive right in. The real estate professional grouping election under Section 469, that's dash 9G, is a pivotal tax strategy for individuals seeking to deduct real estate losses against ordinary income. Normally, real estate activities are considered passive by default, but as we know, with real estate professional status, we can make them turn from passive to active. And when we do this, we need to also qualify for a 500-hour or 100-hour more than anyone else, or a few other tests. There's actually 7 of them that make the actual real estate property itself count as material participations. Usually, if you have multiple properties, doing 500 hours per property doesn't make a lot of sense, so we do something called a grouping election. Now, the grouping election is essential for many real estate professionals who actively manage multiple real estate properties. So a common case could be a real estate professional with multiple long-term rentals. This is very common. Without grouping, as I said, a taxpayer must materially participate in each individual property. For example, managing 5 properties and spending 200 hours on all of them collectively would not qualify unless each property had at least 100 hours or otherwise met one of the other material participation tests. So grouping allows that 200 hours they spent to basically treat all those properties as a single activity, and it will meet material participation from that. Another one is self-managing landlords, so folks that manage their own properties and like to do the tenant screening, negotiations, that sort of thing. If they have hours, again, spread across their properties, a great thing they can do is make this grouping election, and then it all counts as one activity, and they qualify as real estate professionals. For married filing jointly, material participation is actually measured at the joint level. So it could be between both spouses, one 250, another 250. A grouping election may allow a non-working spouse who handles real estate full-time to cover passive losses, such as real estate syndications, and include them all as one activity. So that's something that's super interesting as well. Some folks that should avoid the grouping election are folks that plan on selling one or more properties, because when all the properties are grouped, the sale of a single property does not unlock passive losses associated with that activity. Instead, the entire group must be disposed of to free up any suspended passive losses. So this can be a major trap for taxpayers that are unaware of this downside of it. And then taxpayers who don't consistently meet real estate professional status, if they don't do this year after year, the group election continues to apply, but they may not actually benefit from it, and it can create complexity and limit flexibility. And then passive investors and syndications, right? Grouping doesn't magically convert passive time into active participation, right? Investors in real estate syndications, limited partnerships, or triple net lease agreements rarely meet material participation standards, and should usually not make that election. Now, if they have a mix of both, where they've got some passive, some active, well, as long as you kind of group it all as one and you're meeting that test, then yes, it's possible to qualify. So I want to make that delineation. And then the other one is short-term rental operators. If you have a short-term rental, you should not be doing this because the STRs are not treated like rental activities under that short-term rental loophole. STRs have their own material participation rules and typically benefit from more standalone participation tests rather than grouping or long-term rentals. And there are several tax court cases to support this. If we have Bailey versus Commissioner from 2011, Bailey failed to demonstrate material participation in multiple rentals, and the court ruled that without a grouping election, each activity stands alone. So if you're going to do the grouping election or have multiple properties and qualify for real estate professional, make sure you're getting the grouping election here. And then some best practices that you should follow. Make sure that you are, as a client, making sure you're tracking all of your hours in time logs and using a real estate professional status tracker or similar tools like that. We actually offer an Excel sheet to our clients for free to make sure that they do this. We also want to make sure that if you're going to dispose of the property soon, we have a plan for that and we don't accidentally group it in with something you might not want to. And make sure that you review prior tax returns for any existing elections that your accountant might have done. In the end, the grouping election is one of the most misunderstood yet powerful tools to real estate professionals. And if you're working with the right accountant, it can be a great thing. If you're working for an accountant that doesn't really know, it can cause problems, but it should lead to tax savings that are significant, especially when leveraged with depreciation, cost segregation, careful management. And it's not without its pitfalls. So make sure that you work with an accountant that knows their real estate stuff. If you want to work with someone that does, we do this for our clients who have been since 2006. Again, as I mentioned, our contact information is in the description below, and we'll look out for your inquiry. Thanks so much and have a great day.